You have most likely heard traders talk about margin trading and how it can amplify profits. But what is margin trading and how does it work? Hey there, Kundai here. I hope you're well. In this video, I will explain to you what margin trading is, how it works, and go over some important principles that you should know about margin trading. So make sure that you watch this video to the end in order for you not to miss any key information. Consider clicking that red subscribe button below and the bell icon so that you can be notified as soon as I publish a video. Without further ado, let's get right into it. So let's explain what margin trading is. Well, in a simple explanation, margin trading is just a method that anyone can use to buy or sell financial trading assets such as stocks or cryptocurrencies. However, for you to be able to place a buy or sell order with the method of margin trading, you will have to use borrowed funds that are provided by a third party. So in comparison to regular trading or spot trading, margin trading will allow you to access a greater amount of capital. These are borrowed funds, permitting you to leverage your position. So basically, margin trading amplifies your trading position, which results in larger profits on successful trades. And this ability to magnify trading results is one of the most common reasons why margin trading is so popular. In traditional markets, the third party that provides borrowed funds when margin trading is usually a bank or an investment broker. This is different when it comes to margin trading for cryptocurrencies. Borrowed funds are often provided by retail investors or other traders when it comes to cryptocurrencies, and these individuals will earn an interest on the borrowed funds based on market demand. It is less common, but you may also find cryptocurrency exchanges that actually provide margin funds to their users. How does margin trading actually work? Well, when you initiate a margin trade, you are required to commit a percentage of the total order value. This initial investment is known as the margin, and the concept of leverage is closely related to the margin. Basically, margin trading accounts are used to create leveraged trading. The leverage depicts the ratio of borrowed funds to the margin. For example, to open a $1,000 trade at a leverage ratio of 5:1, a trader would need to commit $200 of their capital, and $800 would be the borrowed funds. You will find that different trading platforms and markets offer a distinct set of rules and leverage rates. In traditional markets, such as the stock market, a typical ratio would be 2:1, while futures contracts would often be traded at a leverage of 15:1. When it comes to forex markets, margin trades are frequently leveraged at a 50:1 ratio. You will often find leverage ratios of 100:1 and 200:1 also used in some cases. In regards to cryptocurrency markets, the leverage ratios are typically ranging from 2:1 to 100:1. And you will find that the trading community often uses the X terminology to define ratios. For example, you may hear 2x, 5x, 10x, or even 50x, etc. And these are all terminologies that represent the ratios. So for example, a 2:1 leverage ratio would be represented by 2x, and a 10:1 ratio would be represented by 10x. One popular aspect of margin trading is that investors are able to open both long and short positions using a margin trading account. A long position reflects an assumption that the price of an asset will go up, while a short position reflects that the price of the asset will go down. One thing to note is that whilst the margin position is open, the trader's assets act as collateral for the borrowed funds. It is critical for investors or traders to understand this, as most brokerages reserve the right to force the sale of these assets in a case whereby the market moves against the trader's position, whether it is above or below a certain threshold. Usually, you will be notified before you place your order that your assets will be liquidated if the market price goes above or below a certain threshold. Remember, because you're using borrowed funds, this is why these brokerages or exchanges will liquidate your assets if your trade goes against you. So, for example, if a trader opens a long leveraged position, they will be margin called when the price drops significantly and reaches above or below a certain threshold. When a margin call is issued, traders and investors are required to deposit more funds into their margin account in order to reach the minimum margin trading requirements. Once these requirements are met, this will mean that their assets are safe and they will not get liquidated. If the trader fails to do so, their holdings will automatically be liquidated to cover their losses. This typically occurs when the total value of all the equities in a margin account, also known as the liquidation margin, drops below the total margin requirements of that particular broker or exchange. So let's talk about some advantages and disadvantages of margin trading. Well, the fact that margin trading can result in larger profits due to the greater relative value of your trading position is the most obvious advantage of margin trading. Another advantage is that margin trading allows you to short the market. This means that you can actually bet against the market. For example, you can place a position against the market price going up. This is one very big advantage that seems to make margin trading very, very popular. Investors can also use margin trading for diversification, as they can open several positions with relatively small amounts of investment capital. And finally, opening a margin account may make it easier for you as a trader to open positions quickly without having to shift large sums of money to your trading account. Now, on the downside, the most obvious disadvantage of margin trading is the increase in your probable losses, the same way that it can increase your probable gains. With margin trading, it is possible to have losses that exceed your initial trade investment, hence why it is considered as a high-risk trading method. A slight drop in the market price may cause substantial losses for traders, depending on the amount of leverage involved in the trade. For this reason, it is very important that investors or traders who decide to utilize margin trading employ proper risk management strategies and make use of risk mitigation tools such as stop limit orders. That being said, I wouldn't advise any beginner traders to use margin trading until they have had enough experience and exposure to the markets. This is simply because it is too risky. I would recommend that you start off with traditional trading methods such as spot trading and only get involved with margin trading once you have a good amount of experience and you are confident in your trading and technical analysis skills. Margin trading is very, very risky. When it comes to margin trading, it is inherently riskier than regular spot trading. And when it comes to trading cryptocurrencies, the risks are even greater. This is due to the high levels of volatility that is typical of these markets. Investors that choose to margin trade cryptocurrencies should be very careful and cautious. Though hedging and risk management strategies may come in handy, I personally categorize margin trading as certainly not suitable for newbies or beginners. The ability to perform technical analysis on a chart, identify trends, and determine entry and exit points does not eliminate the risks involved with margin trading. However, these skills may help you to better anticipate risks and trade more effectively. Therefore, I always recommend that traders or investors develop a keen understanding of technical analysis and acquire an extensive spot trading experience first before leveraging their cryptocurrency trades. If you're interested in learning more about technical analysis and trading cryptocurrencies, check out my Ultimate Cryptocurrency Trading course for beginners. Also, consider subscribing to the channel, as I will be providing classes on trading, investing, technical analysis, and personal finance. So I hope that this video has helped you to understand what margin trading is and the essential basic principles that are involved with margin trading. Make sure that you hit the thumbs up button below if you found value in this video. If you want to learn how to margin trade crypto on Binance, check out the link in the description below. It will take you to a more in-depth article about margin trading. Consider subscribing to this channel and hit the bell icon so that you're notified every time that I publish more educational content. With that being said, thanks for watching, and I will see you in the next video.